We're going to get to the bottom of what Tesla is really worth. Hey everyone, welcome to Risk Premium. I'm Charles, and today I'm going to show you what Tesla is really worth and how to value its stock. We're going to go over how to think about what Tesla is worth in a logical, reasonable way without relying on undue optimism or pessimism. We're going to see that there's not a single correct target price for Tesla stock. A lot of analysts have target prices that pin down exactly what they think Tesla is worth. I think this is the wrong way to go about valuing the stock. It's certainly not the way big investors like hedge funds value stocks, and having spent some time at some of the biggest hedge funds in the world, I've come to appreciate the value of their approach. What they do, and what I like to do, is think about a range that the stock can trade in. That range reflects various price targets under various scenarios. The logic behind this is that the future is not set. Many things could happen that could change Tesla's future earnings, and the stock price now attempts to reflect those future earnings. As one outcome becomes more or less likely, the current stock price changes to reflect that reality. So without further ado, let's get into what Tesla is really worth. When thinking about what Tesla is worth, it's really important to focus on what Tesla actually does, and that is primarily making cars. This is really important not to lose sight of. A lot of people hype up the fact that Tesla is different for this reason or that reason, whether it be automated driving, great electric vehicle range, or whatnot. But it's important to keep sight of the fact that at the end of the day, Tesla is a manufacturer of cars, and once it's mature, it's going to be evaluated against its competitors on similar terms. While I'm evaluating Tesla as a potential bet, I'm not including unproven tangential business lines like licensing autonomous vehicle software. Doing so is purely speculative and not based on demonstrated capabilities of the firm. But I am happy to take into account the future expected car sales of the company, perhaps even assuming rapid sales growth, as long as it fits in line with reasonable demonstrated capabilities. So what this means is Tesla should be measured against other car companies. By that I mean I'm going to pick a valuation metric that talks about Tesla and other car companies on similar terms. The metric I settled upon is enterprise value per vehicle sold. So what is enterprise value per vehicle sold, and why have I chosen it? Enterprise value per vehicle sold is equal to enterprise value, which is market cap plus debt minus cash, divided by annual sales volume. This is a high-level metric that doesn't require doing an intricate discounted cash flow analysis or racking our brains trying to prove that Tesla's margins are so much better or worse than other manufacturers. Basically, it's just asking, what are other car companies worth today adjusted for how many vehicles they sell? The reason I want to work this angle is because one of the big questions about Tesla is how many vehicles they can sell. By first figuring out how much other car companies are worth on a per vehicle sold basis, I can raise or lower my expected valuation for Tesla based on how much I raise or lower my long-term expectation of its vehicle sales. So the number I come up with here is that the median car manufacturer has an enterprise value per car sold of about $27,300. You may come up with a similar number or a slightly different number, but the point is to help us ballpark the figure, not nail it exactly. All in all, once Tesla becomes a mature company, its enterprise value per car sold will probably fall near the median for all other car companies. It could be a little higher or lower. There's no way to be exact. Some people will argue that Tesla will have much better margins than other car manufacturers, and that means the company should be worth more per car sold, but honestly, that's pretty speculative at this point, given the choppy profitability that the company has demonstrated so far. So broadly speaking, now that we have this number, we can use it to make a working assumption about what the market thinks Tesla's future sales will be. We do that by dividing Tesla's current enterprise value by $27,300, and we can see that the market can loosely be said to be expecting Tesla to make sales of about 6,400,000 vehicles per year. That's compared to, wait for it, about 368,000 vehicles that Tesla sold in 2019. Obviously, that's a huge difference between expectations and current progress, but it doesn't necessarily mean the market is incorrect. Tesla has demonstrated an ability to meet certain aggressive forecasts in the past, but it hasn't met other expectations yet. Let's look at some of the things the company has and hasn't done. But first, touch that like button because it shows you appreciate this analysis, and also subscribe to the channel and turn on notifications to be sure you'll see my next video. Now on to what Tesla has and hasn't done. Tesla has proven that there is demand for its vehicles from high-income earners. Median household income of Tesla owners from Model X and S is about $143,000 to $153,000 a year. Tesla has proven it can ramp up production at current factories. Success at Fremont and Shanghai shows the company succeeding at production when factories are built. Tesla hasn't proven it can appeal to low-end buyers. Tesla competes well against new Accords and Corollas, which appeal to more well-off buyers, but not necessarily against used Accords and Corollas, which appeal to less well-off buyers. This isn't to say it won't be able to achieve that, it just hasn't happened yet already. And most importantly, for the purposes of this analysis, Tesla hasn't proven it can break ground at new factories faster than one per year. Fremont was a pre-existing factory. Shanghai took about a year and a half to achieve modest production. Berlin is expected to take at least a year to build, and it has been months, if not years, in planning. Same for the Semi and Cybertruck facility, which doesn't have a specific location yet, but is slated to be somewhere in North America. Elon Musk has tweeted about the possibility of a gigafactory in Texas, but there's little public evidence to suggest it's moving forward on that anytime soon. Now let's turn to what all this means for the stock price. As we've said, the current stock price can be said to assume sales will eventually ramp up to more than 6 million vehicles per year based on enterprise value per vehicle sold. So is this reasonable? Well, to be sure, there is likely demand for 6 million new Tesla vehicles per year. After all, there is demand for more than 10 million new Toyota vehicles per year, a huge number of which are Camrys and Corollas that compete with Tesla's cars. The idea that there isn't demand for Tesla's cars has been proven flat out wrong. This is a major reason for the recent rally in the stock price. But in order for Tesla to make use of that demand, it has to create the supply. I repeat, Tesla has to create the supply. Is there a supply of 6 million Teslas? Not anytime soon. Even with all 4 existing or scheduled vehicle factories running at likely full capacity of 500,000 cars per year or a little more, the company is set to max out at a little over 2 million vehicles produced each year over the next couple of years, possibly around 2.1 million vehicles by 2022 or 2023, which includes Berlin coming up in full capacity and the Cybertruck and Semi facility coming on full capacity, assuming both have similar capacity as the previous 2 factories of around 500,000 vehicles per year. So we've got a stock price that is consistent with about 6 million Teslas being sold per year, whereas current existing or planned factories may max out at around 2 million vehicles per year. That means the stock price is essentially assuming Tesla will eventually have 3 times the currently forecast max capacity. In other words, it needs a total of 12 vehicle factories with capacity similar to the first 4. Meanwhile, the first 3 vehicle factories suggest the need for at least 12 months lead time to build the first units and more time to reach full capacity. That means it may take until 2030 until Tesla can even produce 6 million vehicles per year. That means we're 10 years away from being able to prove Tesla can sell 6 million cars. What can change this? If Tesla announced more planned factories than 1 per year, the timescale would get bumped up. But so far, we haven't heard anything about new factories except a stray tweet. And remember, we need to hear about at least 1 per year just to meet the expectations built into the current stock price. That means as long as Tesla opens up 1 factory per year, it's not going to give a major reason for the stock to rise higher than it currently is. So at the current pace of capacity growth, we could be looking at 10 years where the stock price doesn't have to move up a penny in order to correspond to growth that would still be astounding by any reasonable metric. Making and selling 6 million cars per year would rocket Tesla into being one of the largest car manufacturers on the planet. So what does this mean for the stock price? It means the current price fully reflects continued strong performance by the company. That means if you're a shareholder, you've already reaped the gains to be had when the company proved naysayers wrong. Now the company has to beat its own historical pace of progress in order to raise the stock price, which is a lot harder to do than beating naysayers, who are necessarily more pessimistic. Even if Tesla keeps up its production and sales growth, the stock price may not have a reason to move higher for years. That doesn't mean it's a good short here. It just means the stock may be done making big gains for a long time. If you have stock and you sell now, you can always buy back if it dips. All this suggests it's probably time to take the win and rotate into more compelling opportunities. With that said, stay tuned for a stock that I think has up to 77% upside. I'm going to talk about that in an upcoming video. Remember to subscribe to the channel and select all notifications so you're sure not to miss it. Before closing out, let's put some firm numbers on the stock just for those of you who have stuck around this far. I like Tesla at about $630 per share or lower, which provides a 30% price cushion against the possibility that production growth doesn't meet the robust pace of about 1 new factory per year. Note that I'm not considering the value of Tesla's non-vehicle operations, like solar panel and battery sales, which are small compared to the vehicle operation. To the extent that those businesses can grow, I'd consider them an added bonus of owning the stock. But for long-term growth, I can really only make assumptions about the vehicle market, which is much more developed. Having said that, even though I think the current price already builds in expectations for robust growth, I don't like shorting it anywhere below $1,800 per share. This is because I only want to short things that are overvalued by even optimistic valuations. There are too many good opportunities out there to be shorting things that might decline a lot, but might not. The fact is, as I've explained, If Tesla can keep building factories at its historical pace, it's going to hit 6 million vehicles of production annually in about 10 years, which means $900 per share is easily justified as long as it also sells those cars, which seems likely. So it's not a compelling short at today's levels. But if it did get up to $1,800 per share, it would basically be pricing in an expectation of making and selling something like 12 million cars per year. Not only would that assume a huge increase in the pace of production, it would also assume that Tesla becomes the largest seller of vehicles on the planet. That's just a stretch too far, especially because global auto sales have actually been declining for the past couple of years. Note that I'm also setting a very high short target because I'm not considering the value of Tesla's secondary businesses in this analysis, so I need some cushion against the possibility that those businesses will start to create serious value as well. Now, I know that critics will likely say this price range is way too wide, buying at 630 and shorting it above 1800. But the truth is, you don't need to nail the price targets in a narrow range in order to trade successfully. There are so many stocks and other instruments to trade out there that it's okay not to have a position in most of them most of the time. You may even risk overtrading and losing a lot of money on transaction costs and high short-term capital gains taxes if you set your targets too aggressively. In my book, it's better to be very conservative with your ranges, and that means setting your buy targets well below the fair value of the stock. Then set exit prices around their fair value and set shorting levels far above fair value. So overall, I think congratulations are in order to shareholders who have been along for this great ride so far, but now it's time to look for some other opportunities out there. Remember to stay tuned on this channel to learn about a stock that I think has up to 77% upside, which so far has not been commented on elsewhere as far as I can tell. Meanwhile, happy trading, and be sure to check out some of my other videos like this one. Click the thumbnail on the screen to bring it up next.